Picture this. What if you could slice through all the confusion and noise of real estate investing with just one powerful framework? Imagine having a simple system at your fingertips, one that lets you analyze deals faster, lower your risk, and carve out a clear, actionable path to financial freedom. For most investors, multifamily real estate can feel like a maze. There are so many property types, countless strategies, and a ton of unknowns. But what if you had a tool that could bring order to the chaos? That's where the multifamily blueprint comes in. It's not just a chart or a checklist. It's a mental model designed to help you instantly categorize properties, understand their unique risks and rewards, and align every deal with your personal investment goals. Whether you're chasing passive income, long-term appreciation, or hoping to build generational wealth, the blueprint is your shortcut to smarter, more confident decisions. Think of the multifamily blueprint as your map, your compass, and your playbook all rolled into one. Too often, investors look at deals in isolation and miss the bigger picture. But with this blueprint, you'll see exactly how each property fits into your overall strategy and how you can level up as your portfolio grows. Instead of feeling lost or second guessing your choices, you'll have a clear framework guiding every decision. The blueprint makes it easy to tell if a shiny, new Class A building is the right fit for your core strategy, perfect for those who want stability and lower risk, or if a more challenging fixer-upper Class C property is the ideal value-add project, offering bigger returns for those ready to roll up their sleeves. You'll quickly learn to spot the difference between luxury, stabilized assets and properties that need a little or a lot of love. This kind of insight is what separates the casual landlord from the true real estate entrepreneur. By understanding where each property sits within the blueprint, you can confidently decide whether to go for a safe, steady investment or take on a project with greater upside. It's all about matching your risk tolerance, your resources, and your vision to the right opportunity. This is how you move beyond just collecting rent. You start building a real business, one that grows, adapts, and thrives no matter what the market throws your way. The blueprint gives you the tools to think like a strategist, not just a landlord. In this video, we'll break down the different property classes so you can see exactly where each deal fits and what that means for your bottom line. We'll connect building age and condition to financial performance, showing you how the right property can speed up your journey to financial independence. We'll match each property type to the investment strategy that makes the most sense, whether you're after cash flow, appreciation, or a balanced approach. By the end of this chapter, you'll have the entire playbook in your hands. You'll be ready to analyze deals with confidence, sidestep costly mistakes, and make your next move with clarity and conviction. So let's dive in and unlock the power of the multifamily blueprint together. Property classes aren't official ratings. They're industry shorthand for a building's quality, location, and tenant profile. Class A is the luxury tier, new, high-end finishes, top amenities, and prime locations with high-income tenants. Class B is reliable and well-maintained, a bit older, in solid neighborhoods, attracting stable, working-class tenants. Class C is over 30 years old in less desirable areas with dated finishes and lower-income tenants. Class D is the bottom rung, high crime areas, major deferred maintenance, and the highest risk. Understanding these classes is the first step to using the multifamily blueprint. Class A properties are the crown jewels, new, architecturally striking, and located in the best neighborhoods. They attract high-income professionals who expect luxury amenities, rooftop pools, concierge services, and smart appliances. For investors, Class A means stability and capital preservation, low risk, low maintenance, but also the lowest cap rates. The core strategy that fits here is buy, hold, and collect steady income while the property appreciates. You're not looking to renovate or reposition. You're buying the best and letting the market work for you. It's a passive wealth preservation play, favored by institutions and high net worth individuals. Class A is about owning the best and letting time do the heavy lifting. Class B is the dependable workhorse, 15 to 30 years old, in good neighborhoods and appealing to the backbone of the workforce. These properties offer solid cash flow and a stable tenant base. Teachers, nurses, and young families. Amenities are functional, not flashy. Think of community pools and clean older appliances. The real opportunity, light upgrades can boost rents and value, making Class B ideal for Core Plus or value add strategies. Investors get a balance of risk and reward. Class B assets have higher cap rates than Class A, but still have manageable maintenance. Class B is where many successful investors build their portfolios. It's the sweet spot for cash flow and growth. Class C and D properties are where fortunes and headaches are made. Class C is over 30 years old in rougher neighborhoods with significant deferred maintenance and lower income tenants. Class D is even riskier, high crime, major repairs, and management challenges. These properties are hands-on investments, not passive plays. The upside, you can buy at a deep discount and force appreciation through heavy renovations and better management. The strategy here is value add or opportunistic, transforming distressed assets into stable cash flowing properties. It's tough, but the rewards can be massive for those willing to do the work. When you're evaluating a multifamily property, one of the first things you should look at is the building's age. A building's birthday isn't just a number, it's a direct indicator of risk, ongoing maintenance needs, and ultimately your potential return on investment. The year a property was built can tell you a lot about the materials used, the systems in place, and even the types of tenants you might attract. Newer buildings, often called Class A properties, are typically constructed with the latest materials and technology. They have modern amenities, energy-efficient systems, and up-to-date safety features. Because they're less likely to need major repairs in the near future, investors see them as lower risk. As a result, these properties command lower cap rates, meaning investors are willing to accept lower returns in exchange for that peace of mind and stability. On the other hand, older buildings classified as Class B and C often come with a different set of challenges. These properties may have outdated plumbing, electrical systems, or HVAC units that require frequent repairs or even full replacements. The risk of unexpected expenses is higher, and so is the likelihood of tenant turnover due to less desirable amenities or appearances. Because of these factors, investors demand higher cap rates to compensate for the increased risk and ongoing costs. For example, a brand new Class A property in a prime location might trade at a 5% cap rate, reflecting its low risk and high desirability. In contrast, a 25-year-old Class B building could see cap rates in the 6 to 7% range, while a 50-year-old Class C property might need to offer an 8 to 10% cap rate just to attract buyers willing to take on the extra risk and maintenance burden. The older the property, the more you need to budget for repairs, renovations, and even potential code upgrades. These costs can add up quickly, eating into your profits if you're not prepared. That's why, as an investor, you should expect a higher return to justify taking on these additional risks and responsibilities. Age and cap rate are directly linked in your investment decision. Understanding this relationship helps you set realistic expectations for both income and expenses. It also allows you to compare properties on a level playing field, factoring in not just the purchase price, but the true cost of ownership over time. So before you buy, always factor in the true cost of age. Look beyond the surface, dig into inspection reports, and make sure you're comfortable with the risks and rewards that come with a building's birthday. Your bottom line depends on it. Now, let's connect property classes and age to the 4 main investment strategies. Understanding this relationship is crucial for making smart, intentional investment decisions in multifamily real estate. Each property type, whether it's a brand new luxury building or an older, value-driven complex, pairs best with a specific approach. By matching your strategy to the property's characteristics, you can maximize returns and minimize unnecessary risk. Core investments are the safest and most passive, and these are typically Class A properties, newer, high-end buildings in prime locations with stable tenants and minimal maintenance needs. The goal here is to preserve your capital, collect steady income from reliable rents, and let the market naturally appreciate your asset over time. This strategy is ideal for investors seeking stability and long-term wealth building rather than quick gains. Core Plus strategies involve a bit more risk and effort, often focusing on Class B properties. These buildings are still in good locations, but may be a little older or need minor upgrades. By making targeted improvements like updating common areas or adding amenities, you can achieve modest rent increases and appreciation. This approach suits investors who want a balance between safety and growth. Value add is the sweet spot for many investors. Here, you target older Class B or C properties that have untapped potential. Through renovations, rebranding, and operational improvements, you can force appreciation and significantly boost both income and property value. This strategy requires more active management and capital, but the rewards can be substantial if executed well. Opportunistic strategies carry the highest risk but also the highest potential reward. These deals often involve distressed Class C or D properties, major renovations, or even ground-up development. Investors must be comfortable with uncertainty, construction timelines, and market fluctuations. But for those willing to take on the challenge, the upside can be transformative. The key is to choose your investment strategy first, based on your goals, risk tolerance, and available capital. Then seek out properties that fit that strategy, not the other way around. This disciplined approach helps you avoid emotional decisions and stay focused on your objectives. The Multifamily Blueprint is a powerful tool that helps you align your personal goals, risk appetite, and investment resources with the right type of deal. It brings clarity to the process, making it easier to filter opportunities and act with confidence. That's how you invest with intention, not guesswork. By matching the right strategy to the right property, you set yourself up for success in multifamily real estate. Let's see the multifamily blueprint in action with 2 investors and 2 deals. Investor A looks at a 5-year-old Class A property. Her strategy is core, so verify income, expect low risk, and accept a lower cap rate for stability. Investor B finds a 40-year-old Class C property. His strategy is value add, so budget for renovations, plan to raise rents, and target a higher cap rate for greater returns. Investor A buys a bond-like asset for wealth preservation. Investor B buys a project, aiming to double its equity through improvements. Both use the Multifamily Blueprint to match the right deal to their goals. The Multifamily Blueprint isn't just theory, it's a real-world decision tool. That's how smart investors win. The Multifamily Blueprint is more than a tool. It's a philosophy for building lasting wealth. It shifts your mindset from property collector to strategic business owner. With the Multifamily Blueprint, you quickly categorize deals, focus on the right opportunities, and manage risk with clarity. It keeps you from overpaying for risky assets or chasing deals that don't fit your goals. Master one quadrant, build your systems, and expand as your capital and experience grow. Build a balanced portfolio that generates cash flow, appreciation, and protects your capital. Define your strategy, use the Multifamily Blueprint, and build your legacy. If you found this video valuable, don't forget to like and subscribe. Get Suri Capital's Insider newsletter for more insights. Also, register for the next virtual live event. Go to SuriCapital.com. The Suri Capital community is one of the fastest growing active investor communities in the Mid-Atlantic region. If you're looking to dive deeper into multifamily investing, your journey to building wealth starts now. Check out SuriCapital.com today. Suri Capital, building wealth with purpose, driven by faith.